They signed long-term leases on buildings they did not own, filled them with short-term tenants who could leave at any time, and called the whole thing a technology company. It looked modern, asset-light, and unstoppable. In reality, they had built a fragile financial machine that only worked as long as money stayed cheap and belief stayed high. The decision was not just to grow, it was to lock permanent obligations underneath temporary revenue and treat the gap as innovation. Right now, somewhere in the world, a board of directors is approving a decision that looks perfectly rational. The numbers check out. The risks seem manageable. The analysts agree. 10 years later, that decision is cited as the moment everything began to unravel. This is the autopsy of one of those decisions. By 2018, WeWork was one of the most celebrated private companies in the world. It operated hundreds of locations across major cities, had expanded far beyond shared desks, and was being valued at $47 billion. Investors were not looking at it as a landlord with flexible offices. They were being asked to see a platform that would redefine how people lived, worked, and gathered. The scale was real. The story was even bigger. That story mattered because the underlying business was much less extraordinary than the branding suggested. WeWork signed expensive long-term lease commitments, spent heavily to redesign the spaces, and then rented access back out in smaller units on much shorter terms. When markets were strong and occupancy kept rising, the model looked brilliant. Buildings filled quickly. Membership numbers surged. New locations created the appearance of momentum, and momentum made the next round of capital easier to raise. The core decision was to pursue hypergrowth before the economics were stable, and to present that strategy as proof of visionary strength rather than operational risk. Money from major backers, especially SoftBank, allowed the company to expand at a pace that ordinary real estate businesses could not match. More locations meant more headlines. More headlines meant a larger narrative. And the larger the narrative became, the easier it was to defend the losses as temporary, even as those losses kept widening. Leadership also treated governance as secondary to charisma. Adam Neumann was not just the founder. He became part of the product itself, woven into the mythology investors were being sold. That made the company feel magnetic from the outside, but it also distorted internal discipline. Related party deals, unusual control structures, and a culture built around expansion rather than restraint were tolerated because the valuation kept rising. As long as capital was abundant, weak controls could be mistaken for founder freedom. The turn came when WeWork tried to enter the public markets in 2019. Private investors had funded the dream. Public investors wanted to examine the machine. The IPO filing exposed enormous losses, complex governance problems, and a business that looked much closer to leveraged real estate than transformative software. The same language that had helped inflate the company now worked against it. Once the story was forced into plain financial terms, the gap between image and structure became impossible to ignore. What had looked like visionary scale suddenly looked like fixed exposure. Long leases could not be unwound easily. Build-out costs had already been spent. Revenue depended on members who could reduce space, cancel, or disappear in a downturn. The company had presented flexibility as its gift to customers, but that flexibility existed partly because WeWork itself was carrying the rigidity. It had transferred stability outward and absorbed fragility inward. The collapse was swift because it was not really a collapse of demand first. It was a collapse of belief. The IPO was withdrawn. Adam Neumann stepped down. Valuation estimates fell dramatically from their peak. Emergency financing kept the company alive, but survival came at the cost of the original narrative. The business that had once been described as a world-changing platform was forced into the harsher logic of cash flow, obligations, and occupancy. In the years that followed, the structural weakness became harder to hide. The pandemic intensified the pressure, but it did not create the flaw. The flaw had been there from the beginning. A company with massive fixed commitments had convinced itself it was insulated by branding, community language, and investor enthusiasm. When conditions changed, the same model that had accelerated growth accelerated the damage. In 2023, WeWork filed for bankruptcy protection in the United States. formalizing a decline that had really begun the moment expansion outran economics. WeWork did not fail because people disliked flexible office space. It failed because leadership made a business of mismatched time horizons and then priced it as if narrative could neutralize risk. They borrowed permanence, sold flexibility, and assumed capital markets would always reward the performance of disruption. For a while, that assumption made them look like the future. In the end, it exposed how little of the structure could survive without the story. What company today is making the exact same mistake, clinging to the past while a competitor builds the future?